It doesn't look like the Fed is going to cut interest rates anytime soon. So are you positioned to win? I'll be right back. So where are the opportunities in this high interest rate world? Well, I would be looking at short-term treasuries, I would be looking at dividend stocks, and I would be looking at alternative investments. The problem is getting information on short-term treasuries. Not a lot of advisors want to talk about that because it's not particularly profitable to them. Or getting information on dividend stocks, not as popular. Or getting information on alternatives. Not all advisors are prepared or knowledgeable enough about alternative investments to educate you on them, and it might not be their business model to do so. You want to find an advisor that can have those conversations. I'm having conversations with individuals about alternative investments every single week. Now, not everybody is interested, but at least they're informed. And I would say the majority of the people that I talk to are actually quite happy to learn about the alternatives that are available to them and actually surprised that they're available. I'll get responses like, well, how come nobody told me about this before? Or has this always been available? Or how long have you been doing this? Reality is we've been doing it for quite some time. We work with people that are retired or close to it. I know they're going to be interested in a lot of the alternative investments because a lot of people that are retired or close to it are looking for investments that I would say have a defined outcome, meaning we can accurately predict what you're going to wind up with 6 months from now, 12 months from now, 18 months from now, even 3 years from now, just by structuring the investment correctly. And people, in my experience, that are retired or close to it, usually want the highest rate of return they can get. They're just not willing to take a lot of risk to get there. When we're currently in a volatile, high interest rate environment, what should you be thinking when it comes to long-term investing? You need to know, again, what all of your investment options are. So there may be investments that you could invest in now that are likely to be worth a lot more in the future, but long-term could mean a year. That's not that long, but for some people, 1 year is a long term. Could be 3 years, 5 years, even 10 years out. So in your portfolio, most likely you should have a combination of different types of investments, some short-term investments, some mid-range investments, and some long-term investments. Your long-term investments are going to be positions you can invest in now that have a high probability of being worth more later, but it might take some time. There are advantages to those types of long-term investments, things like potential tax benefits. So if it's what I'd refer to as a non-qualified account, in other words, accounts that aren't retirement accounts, individual accounts, joint accounts, trust accounts. Long-term gains are typically taxed at lower income tax rates. So there's a benefit to getting long-term gains on investments, anything over a year, because you're potentially paying long-term capital gains, which could be the lowest tax rate you might pay on that investment. So all of this goes into planning, and you have to make sure you're talking to somebody that can show you all of your investment options. So how do we create a plan that works even if interest rates stay above 5%? Well, certainly if interest rates stay above 5%, I'm going to be pretty interested if I'm retired in some of the guarantees that banks can offer, or even some money market accounts out there. So that interest rate is going to change depending on when you're watching this video. But let's just say right now it's in the 4 to 4.5% range. There's some other fixed accounts out there that might pay a little over 5%. But with interest rates higher, you might want to lock in some money at some of those rates. But again, even if you're getting 5% on your money, market averages are higher than that over time. So how do you get an even higher average than maybe 5% without locking your money up? Because things like liquidity, diversification, the ability to move from one investment to another is still going to be important in retirement. And that's where active management of the portfolio comes in and understanding what all the investment options are. So yes, it's a high interest rate environment right now. It looks like the Fed's going to stick to their guns, probably not lowering rates anytime soon. Take advantage of some of those fixed accounts that are out there right now, maybe lock in some of the money. But the problem with locking it in at maybe a 4 or 5% rate is you have to lock it in. So you're giving up liquidity on that portion of your assets. The question then becomes, what are you doing with the rest of your investments? How much risk are you willing to take? And if I am willing to take risk, make sure you're being compensated for it. There's nothing wrong with taking risk with your portfolio as long as you're being compensated for the amount of risk that you're taking. Inefficient portfolios have high risk and low returns. High risk is fine as long as you have high returns, and make sure it's balanced. So analysis and planning can help you with that. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.